Raising additional equity. Let's say, for example, I want to let this company grow. I need more equity. What I could do now is I returned earnings. So if this company made some profits, instead of giving the profits to you via dividend, we can just put the profits back here into the tin. And then the company would become more valuable, and you would see usually the share price rise then as well. So retained earnings is one way to get more equity into the company. Works only, of course, if you have earnings, meaning if you have profits. Otherwise, there's nothing to retain. Or alternatively, you can issue additional shares. It's also called seasoned offering, and that's a bit tricky. It's also called a rights issue. We do quite a bit of math in a second, but I want you to understand the basics of it. I'll do it slightly different to what's in the book. For example, if I've got another share here that is offering 100% ownership of that tin, if I'm starting to auction that off now, how happy would you feel about it? If I give that tin to somebody else, that would be not proper. So that's a problem here. If I sell additional shares, the existing share owners are affected because they're losing part of their company, so they're not going to be happy. At the same time, let's say if you're running out of cash for today, and we have good projects for the company, there's a good reason why we want to get more equity in. So we have to somehow solve that problem, that we don't want to harm existing shareholders, but we still want to have the potential to get new equity finance in by selling additional shares. And the trick for that one is to do the new share offering with the so-called rights issue. So what we're doing is we're going to sell new shares, but the only one right now that is allowed to buy these shares is you. So you can imagine, I'll just give you another piece of paper which says you're the only one who's allowed to buy these shares. Is that a disadvantage for you? No, if you're the only one who can buy it, that part is not a disadvantage. Now, you might still not have any cash, so you can say, well, I have the right to buy them, but I can't buy them because I don't have any more cash on me right now. Therefore, these rights are tradable. You can simply sell that right to somebody else. We see in a second with a math example that takes away all potential disadvantages of dilution of ownership of the company, because you get money in by selling these rights. So that's the whole point why we have a rights issue before we issue additional shares. It has all to do with legal ownership, that we don't want to harm the existing owners. Maybe let's do a practical case here first. So Deutsche is thinking, or not only thinking, in April Deutsche did a so-called rights issue or sold additional shares then as well. So that's not an IPO. Deutsche Bank is around since ages, but they sold additional shares via rights issue. Oh.
$500 million after pricing its new share sale. Sue Keenan has the details from New York.
Analysts say the environment for Deutsche
expects to raise around $8.5 billion.
So here it is, 8.6 billion. They want to raise in new shares, so quite a significant amount.
$1 billion after pricing its new share sale. Sue Keenan has the details from New York.
Analysts say the environment for Deutsche Bank's share sale to initiate this week is, quote, almost perfect, given the higher interest rates for banks, which will certainly enhance profits, and the strong equity market. Now, the share sale is preparing to take place between March 21st and April 4th.
It's an interesting issue. So they want to sell 687 new shares. So this is not the dollar numbers, but simply the amount of shares they're going to sell. Remember the two numbers, so it's 8.6 billion in dollars so they want to raise by issuing roughly 700 million new pieces of paper.
The bank announcing in a statement on Sunday they were pricing the shares, which will raise about 8 billion in euros, at 11.65 euros a piece, and that...
So 11.65 euros they want to gain for each of these pieces of paper. It's not for sure if they can get that, but that's their goal.
Comes to about a 35% discount on Friday's closing price.
Now what does that mean? 35% discount compared to the price. So the new shares are sold cheaper than the old shares. And after the share price issue has taken place, new and old shares will be identical. There won't be any distinction between them anymore. So it looks like there's a chance that new shares are a bargain because they're cheaper. But now remember, in order to buy the new shares, what do you need? You need the right. And there you can see why the rights are going to be valuable. Because with the right, you can buy the new, cheaper shares. And that's why the rights are being valuable. And that's why you, as a previous owner of these rights, will be able to earn money by just selling the rights.
Investors can buy one new share for each two they already hold. So the sale only available to those who are existing.
That's another important piece of information. So you can get one new share only if you have two old shares. You need two old shares in order to get one new share. So there's a certain ratio between new and old shares, which is going to be important. All the stuff, by the way, comes on the next slide in the formula as well. That's the reason why I'm harping.
Investors in Deutsche Bank. Now, CEO John Crine, as you may recall, was initially opposed to yet another capital infusion, which will be the fourth for the bank since 2010. But when they saw their share price double from the September low to recently, they were unable to find a buyer for a consumer banking unit. And so the share sale is on.
Maybe a little bit of background information. So it's the fourth time that they're raising additional equity in the last 6 years. A very unusual situation. Usually raising new equity happens very, very seldom. Deutsche Bank, however, has been in quite a bit of trouble since the global financial crisis. And the regulator said, you need more equity capital. That has to do with regulation, which we will cover in later weeks. But it's basically not that they are doing fantastically well like Amazon and another company and everybody wants to get an ownership. It's because they were told to get more equity in. That's the reason why they had so many equity or share issues in the past. Also, she said that the share price doubled. Sounds fantastic. So it doubled, but it fell beforehand by like 80% or so. Deutsche Bank share price went massively down since the global financial crisis. So I don't want you to get out of this class thinking that Deutsche Bank is doing fantastically well and is a growing company. Careful.
Interestingly enough, the two largest shareholders for Deutsche Bank, which are China's H&A Group and Qatar's royal family, both are said to be lining up to purchase shares, and that's according to people close to the matter.
Good. So that was a practical side. Let's move over to the theoretical side. So the best way to understand the rights issue is, I imagine, just to think of the company as a total cake, or the value of the company, the equity in the company as a cake. Let's say Jim and Jane both got the cake company, just as in this example here. Everybody's holding 50% of that cake. Now Jim thinks we want to increase our company. We want to get a bigger company. We want to get new cake trucks in. We want to get more machinery in. We want to buy additional buildings. We need more finance. We could either use bond finance or equity finance. Jim wants to use equity finance. So he wants to issue new shares. And Jane, however, is not very keen on it, right? Because she simply doesn't have the cash. And she says, well, if you want to issue new shares, that's perfectly fine. But I still want to be 50% owner of that new company. Now, of course, Jim is not very happy because if he's plowing in additional money, he thinks he should have a higher stake in that company. And the way to solve that is exactly as we just indicated beforehand, rights. So Jane will maintain 50% of the rights of these new shares. That doesn't mean that she has to buy the new shares, but she has a right to buy these new shares. This is something that you can keep in the back of your mind. Makes hopefully the calculus easier. So here we have our proper number example. So the rights are allocated in this example here, proportional number of shares they hold. For example, here 145. So there are certain things that we need to know here. Number one is the proportion of old shares to new shares. That's going to be important to know how many old shares I need in order to get the right to buy one new share. Yeah, another thing that is going to be important is that we have something called ex-right date and cum-right date. That's on the next slide. And the so-called subscription price is how much the new shares will cost. This one here maybe makes sense. There's firstly an announcement date where we say, okay, we want to raise new equity at certain price to certain conditions. And then there's the end date here where everything is finished. And in between there is a time where the old shares are traded cum rights. Cum is Latin for with. So here the old shares have kind of a right attached to them. You can imagine all the old shares have a right to buy new shares. And at a certain date, ex-right date, you take scissors, or virtual scissors you might think of it, and cut the rights loose of the old share. So then you can trade old shares without rights and trade the right separately. So the right by itself will have a value. So that happens for a certain amount of time where you trade old shares and rights separately. And then at subscription date, everybody who has now the right in their hand has the right to buy the new share at subscription price. And then the very next day, of course, the rights are becoming worthless because all the rights have to be used on that date. And then afterwards here we just have old and new shares all mixed together. All will have the same value. There won't be any distinction between them anymore. Good. Practical example. We have a company that wants to get $28 million via issuing new shares, and we call this one here renounceable rights issue. Renounceable just means tradable rights. The subscription price is set at $2.60. That means the new shares are going to be sold for $2.60. In our example here, the old share was $5. The share price increased to $6, but now we promise the new shares will be sold at $2.60 on subscription date to people who have a right in their hand. Now, how many new shares do we need to issue? Well, if you want to get $728 million in, and each share is going to be sold for $2.60, it means that we have to print 280 million new shares. And if I say print, of course, nowadays the shares are not on paper, but all virtual as an internet account, basically virtual contracts. But the idea is exactly the same. We need 280 million new shares. And remember, the ratio between old and new shares is important. So the current shareholders, the old shareholders, have the first right to these 280 million shares, and therefore we will have 280 million rights. Now, who's getting these rights? Currently, we have 2.24 billion existing shares. So these are the existing old shareholders. And we get 280 new shares, and the whole thing goes proportionally. So that means that we need 8 old shares to get 1 new share. That means we need 8 old shares in order to get 1 right that allows us to buy 1 new share. So it's all about the ratio between number of old shares, number of new shares. In the news article just beforehand with Deutsche Bank, they said 1 to 2. So you just needed 2 old shares in order to get 1 right to buy a new share. Here in our number example, it is 1 to 8. So I just imagine that if you have all 2.2 billion shares, that means you should get all 280 million rights because you're 100% owner. If you have 50% of all these shares, you should get 50% of these rights, 140, and so on. That's the reason why this number is important. Good, and now it's your turn, because I can tell you as much as I like about these things. There's also formulas in the book, but I think a much better understanding comes to you once you figure that out by yourself. And what I did here is, even without any previous knowledge, if you just take each of these questions step by step, slowly, then you will end up with the exact correct answer in the end, and hopefully on the way the penny drops to what the trick here is with the rights issue and how everything is connected. Especially once you figured it out by yourself, it's going to be much easier later on in the exam. And remember here, exclamation mark, should be exclamation mark here really. That would be even more useful. Yeah, I mean, in the exam, of course, you will get different differently phrased question, different numbers, so don't memorize these things. Remember, it's kind of an open book exam too. So it's important to me that you understand being able to do this. Rather do any errors here in class than later in the exam. Good, so what's the basic logic here? Let's make that with yelling in very quickly, that we all get it. So market capitalization basically means how big is the cake. That's what we're starting with. So we have 2,240 million slices of cake. Each slice is 360 big. So altogether we have 8 billion something. Maybe somebody can yell it in. 8.06 sounds about right, or 0.5 something. Market capitalization, so that's how big the cake was before we have any additional equity in. What is the market capitalization after issuing $728 million? So that's 0.0728 billion on top of the cake. So now the cake is getting bigger. So we get 8.7 something, thank you, billion. So that's how big our new cake is now. How many shares will there be in total? Because we issued new shares, so we've got more slices now of that cake. Yes, we have a bigger cake, but we also have more slices. That's the next thing that we want to calculate. So we had 2,240 million shares initially. Now we're selling new shares. This is the dollar number, but the amount of shares is the dollar number divided by the subscription price, how much dollars we get in for each new share. So we're selling 280 million new shares, plus the old slices, 2,240 is 2,500 something, is how many slices we've got now in the new, bigger cake. How much will each share be worth? So that's basically the question, how big is each of these slices? So we take the new market capitalization of 8.7, I think it was, roughly, divided by 2.5 something, and then we get, what as number here? $3.48. So this is basically how big each of the new slices is now. This is also the share price after the subscription date. Remember, the subscription date is when the new shares are actually issued. So beforehand we have the old share price, and then we have all of a sudden the new share price. So afterwards here it's 3.48, initially after the subscription date. So now comes the next trick question, how much is each right worth? So we need one right to buy one new share. First question, the subscription price on the shares was $2.60. So if you have a right in your hand, you have the right to buy shares at $2.60. The very next day, this share will be worth $3.48. So how good is it to have that right? How much profits do you make when you have that right? 88 or 89 cents, depending on how you're rounding. It's basically $3.48 minus $2.60. This is how much you are maximum willing to pay for that right. Because if you have that right, you can buy the share at $2.60 and then immediately resell it at $3.48. So if you can get that right at 10 cents, you get rich very easily. If you get that right at 50 cents, you also get rich. If you get that right at 80 cents, you also make huge profits. If you get that right at 90 cents, you make a loss. Because now you paid $2.60 for the new shares, 90 cents for the right, so you end up to pay $3.50 all up, but you could have bought the same share the very next day for $3.48. So that's the reason why we can calculate this way now the value of each right. So 88 or 89 cents. But how much does the share price drop? So now we're talking about the old share price, $3.60, towards the new share price that was basically it's dropping roughly by 12 cents. And how many rights do you have on each old share? The ratio, new shares to old shares, was, I think, 1:8. So you've got 1/8 of a right attached to each old share. 88 cents divided by, oh, that's not 89 cents, it's a little bit better. So we get roughly 11% price drop from 360 to 348. There's a bit of rounding in there. But we also have, as an old share owner, rights, and each old share has 1/8 of the right, and the right costs 0.89 cents, so 0.89 divided by 8, and you get roughly 11 cents. So what you see here is, in your example there beforehand, you might lose part of the company as an old share owner. If you don't invest in that company, you lose part of the ownership too. Your old share price is most likely dropping due to dilution. There's more shares now in a bigger cake. But you can sell the rights that you get as an old share owner. And when you sell these rights, it kind of exactly makes up for the drop in the share price, which means that you as an old shareholder don't have any disadvantage by the company selling new shares together with the rights issue. That's the whole point of the rights issue, to protect the rights of the existing share owners, so that the existing share owners don't have any disadvantage by the company issuing new shares. And I know it's a little bit of a mouthful, the whole thing. I personally find it much easier if you think of it, the company as a cake. That's the reason why I make up these pictures. In the book, they have complicated formulas for this too. You're allowed to use them as well if you like them. We can put them on the formula sheet too. But I think this way it gives you much better insight. Also, you understand the economics behind it better. You can see why we actually have the rights here. Good. And I think now you have deserved the right to a little bit of a break.